Hello, everyone, and welcome to our exciting lecture series on financial accounting. And I am your instructor, Jamal. Hi there. Okay, so to begin with, today we are going to start our chapter number 4, which is internal control and cash. Remember, cash is a part of balance sheet. If we just see on a account statement form, so it starts from current assets. Under current assets, it is cash. So today we'll talk about the asset side of the balance sheet, and then we start moving other items of the balance sheet, and then liabilities and owner's equity, and then we finish our discussing these issues. Okay, our first learning objective is describe fraud and its impact. So let's explore this. Okay, describe fraud and its impact. What is fraud? Fraud is an intentional misrepresentation of facts made for the purpose of persuading another party to act in a way that causes injury or damage to that party. So fraud is a huge problem, and it's getting bigger. Not only in just United States, it's like a global problem. So fraud has exploded with the expansion of commerce by the use of internet as well. So in addition, studies have shown that the percentage of losses related to fraud from transaction originating in the third world or developing countries via the internet is even bigger than the economically developed country. So right, so what are the most common types of fraud? They are insurance fraud, check forgery, Medicare fraud, credit card fraud, identity theft. So beside the types of fraud that we discussed in our earlier slides, the most important types of fraud that impact our financial statements. Number one, these are misappropriation of assets and fraudulent financial reporting. Let's discuss one by one. So, misappropriation of assets. This type of fraud is committed by employees of an entity who steal money from the company and cover it up through erroneous entries in the books. Right? So, example include the employee theft of inventory, bribery or kickback schemes in purchasing function, or employee overstatement of the expense reimbursement. You went to the hotel, you booked 3-star hotel, but you make a forge or fraudulent activity by reimbursing the hotel expenses at that you stayed in 5-star hotel. Okay, the other one is fraudulent financial statement. So this type of fraud basically committed by managers. So what are the reasons? They falsely and misleading the entries in the books. So what they do, so they make financial results of the company appear to be better than actually they are. So the purpose of this type of fraud is to deceive investors and creditors into investing or loaning money to the company that they might not otherwise have invested or loaned. So which one is the bigger fraud? Employees fraud or managers fraud? The bigger impact that causes the financial impact on the company, that is fraudulent financial reporting, in which you persuade investors to invest in your company and you forge or you fraudulently make the financial statements look like it is the best company. So here exhibit 4.1 explains the graphic from the elements that make up virtually every fraud. So we can call it fraud triangle. So first element of the fraud triangle is motive. So this usually results from either either critical need or greed on the part of the person who commits the fraud. So sometimes it is a matter of just never having enough. Other times, the perpetrator of the fraud might have a legitimate financial need, such as medical emergency, but he or she uses illegitimate means to meet the needs. Right? Motive. The second one element of the fraud triangle is opportunity, which is committing fraud usually arises through weak internal control. It might be a breakdown in the key element of control, such as improper segregation of duties or improper assets access. The third one is uh, sorry. The third one is the rationalization, which is just once. For example, if I won't let it happen, maybe somebody else will do that. So this is called rationalization. So a fraud is the ultimate unethical act in the business. Even if you have a legitimate motive, but you are fulfilling that motive through illegitimate way. So here comes our second learning objective, that is explain objectives and components of internal control. So let's explain this. So internal control is the primary way that fraud as well as unintentional error is prevented, detected, or corrected through proper system of internal control. So internal control is a plan of organization and a system of procedure implemented by organizational management and board of directors, right? Internal control is designed to accomplish the following five objectives. Number one, safeguard of the asset. A company must safeguard its assets against wastage, inefficiency, and fraud as well. The second one is encourage employees to follow company's policies. Uh, Everyone in an organization, manager or maybe employees, needs to work towards the same goal. A proper system of control provides clear policies that result in fair treatment of both customers and employees. So the number third is promote operational efficiencies. So companies cannot afford to waste resources. We already know that. Then they work hard to make a sales and they do not want to waste any of the benefits. So if the company can buy something for $30, why pay $35, right? And then ensure accurate, reliable records. So ensuring accurate, reliable accounting records, which means they are essential part. So without proper control, records may be unreliable, making it impossible to tell which part of the business is profitable and which part needs improvement. So a business could be losing money on every product it sells unless it keeps accurate records for the cost of its product. The last one is comply with legal requirements. Companies, like people, are subject to laws such as those of regulatory agencies like our Security and Exchange Commission and the IRS, taxation system, and the local government, international government bodies, right? So when companies disobey the law, they are subject to fines, or in extreme cases, their top executives may even go to the prison. So you know that right now there is a very famous case of Nissan CEO. He left Japan in a very mysterious way, and he ended up showing up in Lebanon. You can explore it further on YouTube or Google as well. So effective internal control helps ensure compliance with the law and avoidance of legal difficulties. So the Sarbanes-Oxley Act, we call it SOX. So uh, I will pronounce it SOX. Sorry. So SOX revamped corporate governance in United States and profoundly affected the way that accounting and auditing is done in public companies. So here are some provision that the public companies must issue an internal control reports and outside auditor must evaluate and report on the soundness of the company's internal control, right? The auditors must evaluate, right? And then a special body, a public company accounting oversight board, has been created to oversee the audits of the public companies. So an accounting firm may not both audit a public client and also provide certain consulting services for the same client. If that happens, so a stiff penalties await violators. For example, 25 years in prison for securities fraud, 20 years for executive making false sworn statements. So, exhibit 4.3 diagrams the shield that internal control provide for an organization protected by this shield, which provides protection from fraud, waste, and inefficiency, so that company can do business in trustworthy manner that ensure public confidence. And what is public confidence? An extreme important element in maintaining the stability of financial markets around the world.